everyone, this is your business class
This is a demonstration
for Monday.
of Wirecast.
I'm in Ithaca, New York, attending a conference and exhibition. Some of the work myself and from some other students were accepted into the exhibition, so it's quite exciting. I'm about to go to Cornell to attend a workshop by Francis Chin. You all know him. He's always with this conference, so it's quite exciting. Although I don't look so excited, but I am. Okay, so today I'm going to help you with your homework. Okay, I'll switch to our document. So as you probably already know, that we recorded all the transactions into a journal. Okay, here are the transactions, and here this journal. And you probably already know that journal records each transaction into two different accounts, and oftentimes they end up in two different columns. For example, when we bought equipment, in the equipment account, we recorded as increase. In the cash account, we recorded as decrease. So because equipment is some kind of asset, and cash is also asset. So if we come back to this skill ruler, that when assets increase, it's in the debit, okay? And when the assets decrease, it's going to be in the credit, which is not here, but you should understand debit or credit. And then for this case, if the liability increase, it's going to be in the credit. And if the liability decrease, it's going to be in the debit. Because both equipment and cash are assets, so when they increase, it's in the debit, okay, debit. And when it decrease, is in the credit. And moving on to something that on October 16, we purchased some furniture for the client, but we did not pay. We bought with our credit. So when we did not pay and the shop accept our credit, which means we have a liability, we will pay in the future. So it's in the account called account payable, which means in the future we will pay. We haven't paid the shop, so that is our liability. And at the same time, we spend some money. That's our expense. So expense and the liability. And how did they end up in this skill ruler? If we have some expense, if the expense, of course, you don't have expense, now you have expense, the expense increased. So increase in debit, okay, liability also increase, both increase, but liability increase is in the credit. So that's what happened to this. Okay, October 16, expense increase, liability increase, one in debit, one in credit, okay. Another, for example, here, okay, here we have 10,000 recorded in the transaction. Each time when there is a transaction, at least two accounts will be affected. But sometimes the trick is to know which account. So the story about this 10,000 is that we charged the client for some kind of job we haven't done. It's almost like a client will give us a deposit. She has not give us a deposit yet. We send out an invoice and ask for money, and that is account receivable, which means in the future we will receive the money. And then at the same time, we created some liability for ourselves because we promised the client that we would deliver the design, which is also 10,000. So in this transaction, although money hasn't happened, we haven't received the money, we haven't done the work, but there is transaction because in the future the money will come in. So because this is accrual accounting, that is not cash accounting. So whenever there is this transaction would be, whenever there is this, it's actually a transaction, the money will be recorded whether the cash come in or not. Yeah, in this case, the cash will come in the future because it's account receivable. If we received, then we will record it in our revenue. But if we haven't received, it's in the account receivable. And at the same time, we have a liability. So that's how it is recorded. Okay, assets. Okay, account receivable. It's almost like a cash. It's an asset. Okay, unearned design fee is a liability that we would have to do the design. That's our liability. Okay. So, for example, okay, the last column
This is a demonstration of
that we paid back some bank loan, which is this number. That so we paid back with our cash. So the cash reduced. But cash is asset. Okay. If you like, you can always put the category so that you understand better. Okay. So cash is asset. Asset reduced. Okay, come back here. Asset increase is in the debit. Asset decrease is going to be in credit. Okay. Assets decreased. Cash decreased. Liability reduced because we used to own this much, but once we paid back, there's reduced liability that is going to be in the debit, because if liability increase is in the credit, but if it's decrease is in the debit. So if we just do what we needed to do and understand each transaction, which two of the accounts are affected and what type of accounts, okay? So what type of accounts is it? Assets, expense, owner's withdrawal, liability, equity, or revenue? We figure out what type of account, and then we can record them accordingly to the debit or the credit. So all of this, I believe, is finished. Okay, so the journal at the moment is finished. So when the journal is finished, then we would combine the transactions into a ledger. For example, there are quite a few transactions all involved cash. We would combine them together. Okay, if we just go back and look, okay, here, October 1st, there's something cash. There's another cash. Okay, here's another cash. Okay, here's another cash. Okay, if we combine all the cash transaction that involved with cash together, we would record based on this day. Okay, October 1st, we have debit recorded because that's our initial investment. Okay, and then we have another debit recorded as a bank loan that also comes into our business as a cash. Okay, so this cash recorded. Okay, this cash recorded. Okay, and then
this is a demonstration of
this is not cash. This column is not cash. This is also not cash yet. This is something different. Okay, you just need to record all the cash, and then once you've done the cash, you'll come back and look at a different account. For example, we can look at the 301, or we can look at any of that. But I have the numbers for you, and the numbers is very easy to be seen in the Excel. Okay, so if you look at the Excel, there's two things highlighted. Those two accounts are new accounts. That's for future job. It's not in the journal, and also it won't be in the ledger. So in the ledger, once you pull all the accounts together, they're cash, account receivable, furniture, equipment. Okay, you notice the equipment is recorded as debit because we bought all together 75,000. We have a computer, we have a truck, and we have Rhino and Very. All of those combined is this balance here. And then this is new one, so you can ignore for now. If you're doing your ledger and then you're moving on to 169, 201, 202, 203, 301, and 501, 502, 701. So once you've done your ledger, you should have all of this, okay, except for 168 and 612. So you have all of them as your in your transaction and in your ledger, okay, in the journal and as well as in the ledger. So what's also beautiful about this, I would just to add in one thing, is that when all the accounts and the balance brought in, that you have a 100, account 100, 101 to 169, account 200, account 300, and something bigger, okay? So what happened is when they put together the 100 accounts, which is in red, is your asset. Okay, as you can understand now, when we put all the ledgers together and put into this spreadsheet, which you're doing these two columns, you're not doing the rest four, you would be able to see the balance of your assets and of your account payable and also equity and all the rest. So when the accounts got put into this, you have a different groups of accounts. Assets, liability, this is your liability, payables, and equity and the rest. This column in the future is going to be used to calculate profit. So of course you may ask why we have all these columns. I will come back to explain, but I can just give you a hint, because once we're done recording all of this, they're all transactions, which means money changing hands. Even that sometimes account payable and account receivable doesn't have real money changing hands, but still we consider that to be transaction, okay? But our business is not only reflected through transactions. Sometimes we have some depreciation, sometimes we have other things that, accumulating, that's going to affect our assets or our profit, which we have not considered. For example, those depreciation that really hasn't been recorded. So if we look at this is altogether the total number of assets, then you probably realize that you actually do not have this much as your business assets, because something went away, depreciation, is not recorded because it's not a transaction. What we recorded are transactions. If for example, depreciation is not a transaction, but it's affecting our business, so it's not recorded. That's why we need to adjust them, and then we see the reality of the business. Okay, that I will come back to that and give you more explanations. So now let's finish all of this. Okay. So I'm already finished with account 101, cash. Okay, account 106, I believe there's only two. Those are the two invoices. So invoice is account receivable. We will receive the money in the future. Okay, is recorded in the debit column, and you should know that once you've done all the ledgers, that you would have a number either in debit or in credit, but of course not in both. Yeah. So for example, equipment account. Okay, we first have a 40,000 truck, and then we have 20,000 computer, and then we have Rhino and Very. All of this is recorded as within the real value. This is the real in reals. That's in the debit, because this is a positive. This is increase when we bought the truck. We have equipment account increased this much in value, and then this much, and then this much. So altogether you have a balance of this.
Demonstration of
If you
Wirecast.
tend to get confused, you should write debit or credit, or you would have recorded under the column debit, so that once you bring in the number to the Excel, you would not record them in the wrong column. So we have furniture, 161, which is a positive asset, as this much. We have a prepaid expense, which is the plotter. That is also an asset because we bought the service. It's just like we bought the furniture. When we bought the service, it's also our assets because you paid money and it's converted into our assets. It's recorded as this much. Account payable, so we done. I believe we finished all the, maybe there's one. There's one more. Yeah, there's all of them. We have 101. 106. 167. 161. 169. So we recorded all the 100s. All of these 100s. If you check. Now we move on to 200s. We have 201. We have 202. We have 203. So 201. So basically the 100 is our assets. We're done with our assets. Now we move on to liability. Accounts 200. We have a payable we would have to pay in the future. Liability, liability grow, liability increase is in, liability increase is in the credit. Of course, liability decrease will be in the debit. So liability, so we have this liability, and then this one is a number, actually the liability reduced. We have, once we paid with cash, the liability with the bank reduced, so it's on the opposite side, increase, decrease, and then this one is also liability of the unpaid, unearned design fee. So we do have account 301, which is very easy. Let me just copy this. You can do the same and paste. Account 301 is, let's change this. 301. What is the 301? Is owner's equity. If we come back, account 301 is owner's equity, and is recorded as equity, and check equity. Equity is green. Equity increase. We have some owner's equity. Before the business, we don't have any equity. After the business, we have some owner's equity, which is owner's share, increased in the credit account. A credit column. So, account 301, owner's equity. Come back. Here. Owner's equity. Account 301. Which day? A little bit drop. On the first day, I believe. October 1st. If you don't, this is no big deal, but write it down. Account 301. Liability. Owner's equity 100,000. If you really want to be a good accountant, you do this with a comma. So we done 301. So let's do a few more. So we'll finish this. Copy, paste 3 times because we got 501, 502, and 701. So let's just change. So this one is finished. This is new one, 501. I'll go back and check what they are. 502. 701. So let me see. 502. 701. So we need to change the name and the date,
Wirecast.
all of that. Okay, let's just go back. Hopefully I have a good memory. Okay, 501, 72 in the debit column, October 16. Cost of goods. Okay, good memory. 501, cost of goods, October 16. 501.
This is a demonstration of Wirecast.
Cost of goods, expense. Okay. How much? 72,000 in the debit. Okay. 72,000 in the debit. 72,000. Okay. So
This is a demonstration of
we have
Wirecast.
2 more that I didn't finish. Okay. I can finish them, but probably I will stop here. Okay. You will just do it yourself. Do 502 and the 701. Record. Okay. Let's ignore most of it. Highlight as not correct yet. And then just bring in the number. Okay. 502 and the 701. 502 is here. Okay. The number is 85 on credit. Okay. 701 is, where is the 701? What is it? Check this. Okay, 701 is design fee. Where is that?
This is a demonstration of Wirecast.
Is it not recorded? Okay, it is not recorded. So it's probably a new account. The design fee is the design we actually have done, but not in the transaction. Okay, this is not to confuse the invoice. Okay, the invoice is 10,000. Okay, once we got invoice, we got assets and we got liability. Okay, recorded, but that 4,000. Okay, we actually do not have account 701 because account 701 is going to be a new account only in the Excel, because this one is the reality. I highlight this one with green, which means it was not in the journal or ledger. It's something that it's actually the money we actually made by end of the month. Yeah? So if you look at this one, maybe you understand better, because the money we did not make, we sent out the invoice, we created some liability, 10,000, but then we eventually, by end of the month, we actually did 4,000 of the work, which is not a transaction because no money is involved, but we have to record it as the reality of the business. So here, there's 2 columns. If we want to say, is the reality. Okay, reality. Okay, reality, but not transaction. This is not transaction. Okay, there's no 4,000 coming in or going out. They're just reality that we actually finished the 4,000 of the work that by end of the month, which if you look at our story, okay, from the beginning, okay, where is it? That we've done 4,000 of the work, maybe somewhere. Okay, here, in the story, that we say, okay, during this period of time, we finished the 4,000 of the work. Okay, this is not a transaction. No money change hands. Just a fact. Okay, So this is same as
demonstration of
depreciation. That
Wirecast.
means no money changing hands. There's no transaction. But it is affecting our business because this is the real money that we actually made. We needed to be paid 4,000. Yeah. By the end of the month, we made this money already. Okay. So now, if you done that, okay. So there's account 502 is at 85,000 recorded in
This is a demonstration of
502
Wirecast.
in the credit column. Credit, okay. So I put 85. Okay. Sorry, this account credit. Okay, correct. Cost of goods. No, wait. Goods sold to clients. Okay, that's this much we sold. Cost of goods is in a different column. Okay. Account 501. Okay, this is cost of goods.
This is
Is
a
in a
demonstration
different
of
column.
Wirecast.
Okay, this one 72. Okay, so now let's look at this. Yeah, I would briefly come back with a in-class lecture to explain more. Okay, here, if you add all of this number together, you end up with a total amount. But
This is a demonstration
thinking
of
about our
Wirecast.
assets, we got all of this, yes, positive, negative, all of them are positive actually. Yeah, even the cash is still positive. So we got this number, yeah, so they're all in debit. So if the cash become negative, they can be in this column. But this is not our reality by end of the month because our assets somehow in between shrink. There's a little bit of depreciation. And also, we also use the part of the service that we paid. We no longer own 3,600 of the plotter. We only own 3,300 because we already used the 300 from that deposit. So this and this are the amount that actually affected the business, but not through transaction. Okay, you always have to remember, everything end up here. They're called unadjusted. Okay, they are the transactions, but the transaction is not the reality. There are some things that happen to our business, either affect our business positively or negatively through not through transaction, but it is affecting the business. So in this case, we will have to adjust this column if it's. But the number that we put, of course, debit or credit, okay, so depreciation reduced, yeah, because it's assets, all of this is assets, reduced assets is in credit, okay, this is also assets, reduced assets, there's less, yeah, 300 less, 350 less, this is just guesstimation, yeah. I believe this number is wrong. I should remove this number, yeah, there's mistake in here. And also this is also our new account. It doesn't exist before the adjustment. So if we look at this number minus this 2 will be our new balance, okay? So let's just put this 2 together as a total number, and we will do a little formula here. Okay, formula is this one minus this one.
This is a demonstration of Wirecast.
And maybe I need to insert the formula. Okay, let's see. Formula this one minus. Oh. What is this?
This is a demonstration of Wirecast.
I'm not doing very well. Okay, I have a little problem here. This one minus this one. Okay, I can come up with a number, even just use a calculator. Okay, maybe I'll do this. Okay, I'll think about that later. Okay, it should be very easy in Excel. That's why a lot of accountants would use Excel, because they just automatically will come up with a number.
Demonstration of Wirecast.
Okay, so eventually, if we've done that, we will come up with a number as our total assets by end of the month. And here, account payable, there's a loan payable. Okay, let's check. Account 202. Okay, account 202, we have a loan payable. No, bank loan, account 202. Okay, bank loan.
This is a demonstration of Wirecast.
Started. Okay, first started from. Okay, I need to see, check. I think that one is wrong in here. Okay, because it did not show. This is not correct. I need to insert another column. Okay, actually this all
is
of
a
this
demonstration of Wirecast.
is in here. Okay, we actually have another, which is on the first day of our business. We took some money, which is also in the same account. We took out some money, so how much we took out? 50,000 from the bank. Okay, increase the liability, decrease the liability. And how much is the balance? Okay,
This is a
we can
demonstration
come up
of
with a number.
Wirecast.
50,000 minus 50,000 minus 2083 equals to 47917. 47917. Okay. 47917. This is the correct number.
This is a demonstration
Might
of
not be in that
Wirecast.
column. Yeah, one column. I think it's in this credit column. Yeah. It's in the credit column, correct? Yeah, in the credit column. If you like, say whatever that number is. 47917. 7917. Okay, so I think this is good enough. Finish just like middle school math and finish all the numbers. This is of course wrong, yeah, but number is correct. So finish all the numbers and put all the numbers here. Put all the balance from your ledger, all of this, but not this three. Okay, this three, you would not have any number in there. Okay, you would not have any number for these three accounts under these two columns, because they're new stories that we need to introduce, which is this column. Okay, and hopefully we'll get to the numbers here. We will see our real assets, okay, after we have all the transaction plus a little bit of other story happening but not transaction, and then we got the real number of our assets, of our liability. This is all your liabilities here. Okay, this liability is easy to see. Okay, the reason that here is 4,000 is actually by end of the month we finished the 4,000 of the work. When we send out the invoice, this is how much our liability is, but need to be minus with this number. And then in this column, we got liability reduced to 6,000. Okay, this number is still the same. Okay, this number is just copy and paste, or maybe somehow. Okay, so So the total liability,
This is a demonstration of
slightly
Wirecast.
messy, is just all of this. So this is how much the liability. Did I record it right? No, I recorded wrongly. Okay, it's not on this column, it's totally wrong. It's in this column. Okay, so hopefully before next week you finished with these two columns, and if you actually already start to understand, you can, I think I gave you all the numbers here. Okay, so these two numbers coming together is this. Okay, so I already gave you all of this, and yeah, let's see, design fee, maybe that's not here. Okay, I'm making quite a few mistakes because once we done the ledger, we're just recording these two columns. We're not touching any of this. So that 4,000 credit is actually here because this is a story for adjustment. Okay, so we have a liability reduced and we made some revenue, and so they are opposite of each other. So what happened is, okay, if you already understand, once if we done correctly, okay, let's remove this number. We'll put all of this number together, and then we have a total number. I'm not done yet. Here, and I have a total number here. They should be the same. Once you're finished, they should be the same. There are missing numbers in here somewhere. Owner's equity, totally. Yeah, otherwise it's all in there. Okay, this is not. This should be empty. This should be empty. This is empty. All the rest number. Okay, owner's equity. Okay, owner's equity started from 100,000. Yeah. Okay, beautifully. So if you done correctly the journal as well as the ledger, you should have two equal numbers. And then adding a little bit of new story that happening, that we should of course have two other numbers here, and then we would end up with this is adjustment. These two columns are the reality at the end of the month. So at the end of the month, if you done good job, you will see in reality how much is your asset and how much is your liability, and how much is your owner's equity, and whatever here is actually going to be your profit. All of this, because what happened is the cost of goods, the goods sold to client, all of this is your money making business. Okay, this is your other money making business. You actually made some money, not by sending out invoice, but actually doing the work. This is your revenue. Okay, revenue is in the credit. Okay, let's take a look. Okay, revenue, where is revenue? Revenue is in the column. Okay, it's here, the green. So if revenue grows, that is in the credit. Okay, you end up with a positive number here. Okay, because design fee that you actually made, this is a reality. You made the fee, you made. Okay, this is your revenue. Okay, so hopefully you'll be done next week in the beginning of the class.
This is a demonstration
Monday.
of Wirecast.
Okay, numbers here, and a correct number, which I have already finished. So I've done your work. Okay, so fabulous. This is all the numbers, but you do need to understand how we get here. Okay, I'll talk to you soon. Okay, what happened is I will tell you a little bit more story. So I'm a little bit exhausted after all this lecture. I will tell you what we needed to do in 5 minutes on Wednesday, so that you're all prepared for class. So the next lecture won't be long. Actually, there won't be any lecture. It's just an announcement. Okay? Talk to you soon. Bye. Have a good time in Doha.